So I think it's the bright star, obviously, financial securities industry. And there's no reason not to buy a life insurance policy, which people have to do. I finally had to do that. What's the age? 58 is when people buy the most life insurance.
Really? That's the
number? I got a number for everything. I'm like,
that's why I love watching your content, because like every time I watch you got like this random statistic that I'm like always blown away by. It's awesome.
Yeah. So I mean, that, that is, they still have positive demographic trends where most other industries don't. So it is really the bright star. The error we make, the longer we see something go up, the more confidence we have in it. The smart money, the longer something goes up, the more they say, oh, it's cruising for a bruising. That is real wisdom. This is the longest and the most aggressively the stock market and all financial assets, especially real estate, that didn't even bubble that much in the roaring 20s, have gone up. That alone should be a huge caution, whether I'm right about the timing exactly or not. This is a time that's going to pay to keep getting out of risk assets and let them crash and get back into them. It's that simple. You almost can't go wrong on this one. It's just a matter of timing. You might get out a little early or a little late, but getting out of a bubble is the most single profitable thing you can do in history.
Hey, what's going on, cash flow hackers? It's Chris with Life 180, and I am here with one of my favorite economists, I guess, in the financial space. He's honestly like my Michael Jordan, I guess, in this space. I've learned so much from this guy. I've followed him for over a decade now, Harry Dent, and he's written a ton of books in this space. Demographic Cliff, 0 Hour, I think is your most recent one, isn't it? I remember I went up to, I took a road trip to Denver and I listened to 0 Hour on the way home, and I got home being like, holy crap, I got to do a lot of stuff. So so I'm really excited to have Harry on here because listen, we have a lot of stuff going on in the economy right now. I think there's a lot of uncertainty. I think a lot of people are trying to figure out, Harry, what the hell is going on and what do we do? How do we prepare? Because I think, and I can't wait to hear your take on this, but I've been saying to people lately is I think it's inevitable that we're coming into this kind of deflationary environment, which I learned a lot from you about. But I also, one of the things that I've learned over the past decade and kind of being in this headspace is don't underestimate the government's ability to manipulate, right? and print money and do all these things, right? And so I guess that'd be a great place to start. It's like if we could kind of summarize. Where do you think we are right now? Like what's going on? What are you seeing as of today? I think, the market is going down again today. It's been going down for a week and a half, pretty much straight, maybe 2 weeks now. And how do you see this playing out? And do you see that the government has any more ammo, to fight this?
Okay, first of all, there's where we are and where we should be.
Totally.
We saw the greatest boom in history. And I was the guy that predicted this in the mid to late 80s, and people thought I was crazy for being too bullish back then. I just saw the baby boom growing up, earning and spending more money, and as the largest generation in history. It's actually my key indicators, the spending wave. It's a 46-year lag on the birth index, which I have to adjust for immigrants and a few other things, but extremely simple. I said, well, this boom's going to be greater than anybody thinks. It's going to last all the way to 2007. And back then, in those late 80s, people were like, what? And I said, the Dow's going to go to 10,000 by 2000, and that's not going to be the end of it. People, oh, no, impossible. So they thought I was a crazy man. And what I tell people is, I'm not extreme. We are in extreme times. Greatest boom and bubbles in history. We have not had a bubble economy in financial markets since the roaring 20s. And it started here in the mid 90s when stocks just took off. We had that first tech bubble and crash. And when that crashed, we had the housing bubble, and then that crashed. And then now we've had a second tech bubble and second housing bubble together into this time period. And frankly, this should have peaked by early 2020. So what's happened here, we are in a time where, first of all, baby boomers peaked in late 2007, something I predicted 25 years before it happened. And so we've been in 2008 looked like the Great Depression. Ben Bernanke was the Fed chairman then, and his thesis in PhD was the Great Depression. And he's like, we're not having a damn Great Depression, okay? And so they just pumped like crazy. Now, here's the thing. They thought $1 trillion would do it, No, they didn't understand that demographics had shifted for a long time. The millennials, so 2008 to 2022, 23 was always to me a long sideways difficult era, like the 70s and early 80s, like the 30s and early 40s, comes every generation, and economists don't see that. So they just had to keep printing and printing. And then when COVID hit, now listen to this. I was even shocked when I looked up the full numbers. Since COVID, $5 trillion in money printing in 2 years. That's more than the 3.6 trillion they did for the first several years after the 2008, 2009 bottom. So they way up, exponentially up their money printing. And on top of that, $5 trillion in fiscal stimulus, which they did not do back there after the 2008-9 crash like that. $10 trillion. That's almost half of our GDP.
Oh my God.
We ought to have 20%, 30% inflation. So what's happened though, they've been able to get away with all this money printing because the economy has been slow. My indicator on inflation is as breakthrough as mine want on the spending wave. Inflation is not driven by oil prices and high economic growth. That can all contribute. Labor force growth, the cost of incorporating young, new, unproductive at first, but expensive to incorporate in the economy. That's what causes inflation when a large group of new people like the baby boomers in the late 60s, 70s were entering the workforce in record numbers. That's why we had high inflation. Back then, economists said, oh, it's government deficits. Oh, it's this and that. Cost push, cost pull, inflation. No, baby boomers entering the workforce. Nobody even suspected it, okay? So, but now we've had that labor force growth slowing as the baby boomers have peaked and the millennials are coming in, but in fewer numbers, okay? So we've had low inflation. Well, look what happened when they finally did this 10 trillion stimulus. Inflation suddenly went from 0.4% to 8.5%, and now 8.3% a month later. So it may be peaking here, but the point is the central banks, because they just don't know any better, and they don't want to, they think the enemy is recession, okay? Life, okay, that's like saying don't go to sleep because you're more productive when you're awake. You know that we're awake about 2/3 of our life and asleep about 1/3. Well, guess what? The economy booms for about 26 years in a generation cycle and then slows down for 14, the same ratio of waking to sleeping. They think recessions and slowdowns should be avoided. They are part of the natural process. All the great innovations, all the restructuring, get back to reality, comes in the downturns, and all of the expansion of those great innovations and the next generation comes in the upturns. So they are fighting, they're treating recessions and a slowdown as evil when the economy, if it was up to the economy, we would have gone into a deep downturn in 2008. We would have bounced a little bit in between and we'd be back in a second deep downturn from 2020 into 22, 23. So that's where we're at. They're fighting this and they keep fighting it. But what we're happening is by creating so much inflation, by over panicking to COVID. Now, first of all, think about this. Why would you pull out such big guns on something, a pandemic that you know from history is just going to last a year or 2 or 3 at most? It's not a weak economy. Hey, people get sick and people are not going to go to work and spend it. Okay, so they overdid this because can't have a recession, because which tells me they understand nothing about the economy. I tell people in my speeches, if we didn't have a good recession every 5 to 10 years, we wouldn't have one honest, productive business left in the entire world. Human beings get lazy, we get complacent, businesses do if you don't get challenged and get this now and then, okay? So we should be in the final deep downturn, which will really be more like a depression coming in here 2020 to 22, and they've kept the economy going up right till the stock market finally peaked in January 4th. And I'll also ask people to notice in my newsletter, a major, minor peaks, most stock indexes peaked yet. We've seen a succession from February 2021 to January 4th of 12 major stock indexes and financial land around the world peaking in succession. That is a sign you're coming into a major top, not another correction. So what I'm saying is finally, despite all this stimulus, by overstimulating, they created too much inflation. Now they have to tighten. They can have no credibility if they don't tighten. Now they're tightening tepidly. They're doing it. They don't really want to, because I have to ask, the audience, who do you think knows how weak the economy is underneath when you've had to stimulate it nonstop and progressively for 14 years when you thought 1 trillion in 1 year stimulus would be done because you think the economy's healthy? They know how fragile the economy is. So they're tepidly tightening, but that's all it takes. All this economy takes to go back down to where it should be: weak spending, financial assets, which are 2 to 3 times the values they should be, come back down to reality, so we can get the excess debt and financial assets out of our economy. So when the millennials do start their boom in 2024, which will go to 2037, not as long a boom, not as big a boom, but that's what will naturally pull us out of this, that we don't have all this debt and crazy financial asset prices. I mean, a young person today to start investing in the 30s and 40s, with the stock market would tell you, without my predictions of a down economy, you're going to lose 2% over the next decade a year if you buy stocks at these valuations. We got to take all these excesses out. The only cure for that is a downturn, and I think it's starting. I think the leading indicators, the best ECRI, say everybody's saying, well, we might have a recession in 6 or 12 months. They're saying we're on the verge of it right now. I think it's starting now. The stock market peaks ahead of that, January 4th. But most stock markets peaked in November, and like I say, all the way back to February last year. But I'd say the real peak of stock markets around the world was in early to mid-November. So we're right on that lag until the economy follows right here in May, June. So I think we're about to start a recession. I think the stock markets are not in a correction. There's a very low chance of making a new high now, and they're going to keep going down. I think by July, I think the stock markets will be down 40% instead of 15 to 20 here. By the end of this year, most of the damage will be done, but we will not bottom in the biggest crash of our lifetime, because 2002 only really hit the tech stocks bad. Yeah. It was a very minor recession. This is going to be a short depression and an across the board, and here's important, across the board revaluation, devaluation of all financial assets, commodities, stock, gold even. Gold went up in the early stages of 2008 and then went crying to mommy, down 50% with everything else. Totally. Even gold's going to go down. It may be the last. So you can't sit there and say, well, I'll rebalance my portfolio and da-da-da-da-da. No, you have to get out of all risk assets. And there's one safe asset class that is proven in the early 30s, in 2008-9 crisis, and now. The three analogies to what I'm talking about. Mm-hmm. The one thing that went up in the 2008-9 crash and 30 to 32, long-term treasury bonds. People say, oh, the US government's bankrupt. Oh, not as much as Japan and Europe, who printed way more than we did and have way weaker demographics. Japan's had weak demographics since the 90s. Europe has weak. So we're the best house in a bad neighborhood. We're still the largest country, with the dollar still as the world's reserve currency, whether people like it or not to be forever, but for now, it'll only strengthen. US dollar for foreign investors, treasury bonds. And when I talk to my people in Canada and Australia, I say, you guys really got it made. You can buy US treasury bonds and benefit from the safe haven appreciation of the dollar, which it went up in 2008 at the worst of crisis, and its treasury bonds, which went up 40, 50%. I think this time it's going to be 50, 60%. Imagine being in the safest 10 and 30-year treasury bonds. In the longer term, the better. There's two ETFs, ZROZ, Z-R-O-Z, 25-year average, TLT, bigger and more liquid, but 20 years. So I kind of prefer ZROZ. They're the safest long-term bonds in the world. And you appreciate 40, 50, 60% when all other financial assets are coming back down to reality. That is the safe haven. And when the gold bugs tell you it's gold, they are wrong. Gold was controlled in the 30s. I can't measure, but 2008, crystal clear. Like I said earlier, early stages. Oh, there's going to be a crisis. Oh, it looks bad. Gold goes up. And then when it looked like deflation, gold crashed 50% in a short period of time. It did better than stocks, okay? But it was not the safe haven and will not be again, even more so. So that's it. You get in treasury bonds here, and then you're happy to see this play out. And people ask me, well, Harry, you act like you want a downturn. Yes, I do. We're in insanity land. Financial asset prices, home prices off the chart. Young people can't afford to live anymore. This is insanity. We need to bring it down to reality. All I can do is tell the people who will listen, which is 1% if I'm lucky, all you have to do is get out of the way, because this has to happen sooner or later. And what I'm seeing after being, worried about this for a couple of years, it looks like to me it's happening. This crash has now gotten to the point, and if it goes a little lower, where it does look like the first crash, and the first crash, once stocks are down 30 to 40% in the first crash, it's over. That's what history tells me. You do not break a bubble with a 10 or 20% correction. It takes 30 to 40, and I think we're about to see that. We're going to see that by July. So I'm saying don't wait for that, because stocks will already be down 40% or more.
So the momentum is already picking up.
Opportunity if you think out of the box. But if you listen to your financial advisor who says, oh, that's all right, we got you rebalanced and stocks always go back to new highs. No, my prediction, you will not see new highs in the US stock market, maybe for the rest of your lifetime if you're over 50, and adjusted for inflation, almost certainly not. Real estate, same thing. Adjusted for inflation, real estate has less chance real estate has no chance of getting to these bubble levels, because the demographics of real estate are even worse in developed countries in the future. So this, because real quick, one of my biggest breakthroughs, I lag everything. I lag, the birth index 46 years for peak in spending. Well, I used to lag at 42 for the peak in real estate buying, but I realized, wait a minute, real estate lasts forever. And I have to subtract people who die, who are sellers. So I take the dyers minus the peak buyers, and I've got the best real estate indicator in the world, and it is really negative. So you definitely got to get out of real estate here. And I don't, like I say, I think real estate has no chance of seeing these levels in any of our lifetimes.
No, you know what? And I saw something yesterday. You've probably seen this, but it was something about, it was the 70s versus the 2010, right? Like 2010 till now. And it showed the 70s had high inflation, obviously, but also wage growth went up. So if you looked at housing value increase, wage growth was actually outpaced the growth of housing. And right now, the last decade, wage growth has actually grown 5.8% less than housing growth, which, I mean, has to lead, like, on top of all the demographic stuff that you're talking about, which is like absolutely relevant. We're talking about, then you stack on the fact that wage growth is so far behind, and it's like the perfect storm for a nightmare.
Yeah, and and there's a big difference. The inflation of the 70s was natural. My indicator would have predicted that regardless of any type of government stimulus or not, or tightening, and and we just, inflation would cause recessions, then it'd come right back. It was fundamental from the entry of the most expensive entry of a generation of the workforce in history. Now, this is the opposite. Inflation should be, by my really good inflation indicator, about 1%, and it's 8.5%. That is totally artificially created short-term by overstimulus, and economists are not acting like we're in a long-term period of stagflation. No, this is temporary, and as soon as we have a downturn, that inflation will disappear faster than you can imagine, and you will never see inflation this high for the rest of your life in developed countries like the United States or Europe, because the labor force growth, which is the only thing that correlates with inflation long-term, is going to continue to be very low unless you're in a place like Southeast Asia and India. So this is really fundamental to understand. This inflation is the price that these idiot central bankers paid for over panic and think you can cure everything with just printing more money. Anybody who thinks that you can push a button, print money every time of crisis, and it ends well, understands nothing about the economy. So you know how much respect I have for the Federal Reserve Chairman and most economists that are sitting there going, ooh, Federal Reserve, keeping the economy doing that. This is stupidity. It is going to end very badly. There's only one, because what did they do? Greatest bubbles in everything. We've never had an everything. You look in history. You ever had a time where all financial assets bubbled at the same time? Not in 2000. Stocks bubble, not real estate. Not in 2007, okay? Real estate had bubbled, stocks hadn't as much. And now everything bubbled everywhere in the world, and they're forced to tighten by their own stupid policies of overreacting to COVID. And this is going to be a global downturn that will rival the early 30s more than 2008 to 2009. That's what I'm saying. It won't be quite as bad because governments will still support the economies in some way, but it'll be more like the early 30s. And that is not something to sit through and rebalance your portfolio. You just gotta not listen. I love financial advisors. They get people to do the right thing and not panic most of the time. They're going to be wrong when they tell you, oh, we'll just rebalance, you hang in there and we'll be at new highs anytime. You will not see, as I said, new highs in stocks. If you ever see them, it'll be 2036, 37, and I'm going to be damn near dead by then. And I don't think you'll see them even then, and certainly not adjusted for inflation. And same with real estate. Real estate will never see this again with the demographics of real estate. But because remember I said the dyers are the important part. It's in my spending wave, the dyers count in real estate. And they're going to weigh down real estate until 2042 when the last damn baby boomer dies. So if you want to buy real estate, wait till then.
So talk to me about this, Harry. So demographically, all the dyers are happening. And so, you know, you have this generational wave of contraction, right? In the demographic. But everybody
every 40 years in the last 120 years. Every 40 years for 12 to 14 years, the economy goes sideways to down, and economists still miss why.
So
they don't know why.
No,
they think it's because the Fed wasn't stimulative enough. Or something.
Right, exactly, totally. So what about immigration? What about all that stuff? Like, what are you seeing as far as like immigration numbers right now and how that plays into everything?
What do you think happens to immigration when the world goes into a big global crisis? Everybody clams up their borders. People are even afraid to move, and it's hard to move again. Immigration drops like a rock. Immigration has been what has made the U.S. economy stronger than Europe and Japan. You know how much immigration Japan has in allowance? Zero.
Yeah,
they have they're the first country to peak in their baby boom demographics, and on top of that, they've never really allowed much immigration. Okay, so immigration has been our strong suit. This immigration is going to dry up faster than anything, and that's going to have ramifications short term, but it's have bigger ramifications long term. The U.S. That's why I say I think the U.S. is peaking here. They will have a millennial boom that will bring us maybe to somewhat near these levels. We'll never be at this level again in financial assets. We'll never be at this level of global dominance because Asia is just going to keep rising. And our millennial generation just is not the force. They're great people, but they're not the force the baby boom was.
Yeah. So now let's go to the dollar, right? The U.S. has a world's reserve currency. You say often that we're the nicest house in an ugly neighborhood, effectively, right? And so a lot of people are really, really fearful of losing the world's reserve currency status, worried about Bitcoin kind of taking over as the means of transaction for commodities, and what will that do to us? So can you kind of unpack that, like what your thoughts are around your bullishness, so to speak?
Well, you know, the funny thing that this downturn is only going to strengthen the attraction of the US dollar as it did. I mean, again, I don't know why I have to argue this with Peter Schiff and people, okay? 2008-9, US dollar was the safe haven and its treasury bond. That was it. That's the two places you made money, okay? So the downturn is just going to make the best house in a bad neighborhood. Everybody's too much in debt. Everybody's overstimulated. Everybody in the developed world has slowing demographics. It was just first Japan and last us. Okay, all of us are facing it. We're the best house. But for Bitcoin, same thing. People say, well, Bitcoin's a safe haven. No, it's the biggest bubble. It's like the dot-com stocks, like Amazon. They came late in the 90s. The tech bubble was already going. They were the big hit at the end from 98 to 2000, the bubble the most. Amazon went from $6 in 2 years to 136, and then in 2 years back to $6. And it was the leading internet retailer then, and is the leading retailer in the whole world now, okay? It was the next big thing. Crypto is the next big thing. So, but Bitcoin being the biggest bubble in crypto, it's gone up more than stocks. And as somebody's now finally pointing out, which I've been saying for years, it correlates with the NASDAQ more than anything. It's not a counter thing. It's not a safe haven. So I think Bitcoin, 69,000, at the top, 2021, and it peaks every 4 years toward the end of the year, like a clock, and makes all of its gains in 1 year, like a clock, and people don't see that.
Yep.
It basically will crash to as low as $3,000 to $7,000.
I hope it does.
So that's gonna be, and I do too, because it will lead. The crypto sector is like the dot-com retailers, the leading edge of technology. It is the next big thing. Bitcoin is going to be the global standard for a digital monetary system, and it's the standard, and Ethereum is like the incubator for creating all types of new crypto, coins and business. And it's not that they just made coins so they didn't have to do IPOs. That was the genius. In crypto, there's so many coins and so many companies launched in here because they didn't have to go through the high expensive regular IPOs. But that means a lot of crypto companies are BS and have to go under. Okay. But Bitcoin is going to be the number. I would be buying the leading cryptos in the bottom of this, let's say around late 2023. And I think my projection, and this is the most extreme projection I have, Bitcoin could go down as low as 3,000, somewhere between 3 and 10, but I think closer to 3, and then go to $500,000 to $1 million. My best estimate, $780,000 by 2040. Now, if you can get better returns than that, 3,000 turns into up to $1 million in 15 years or something. Holy smokes!
God bless you if you got that in you. Yeah,
that's the biggest opportunity. But if people are thinking, oh, Bitcoin's a value now, it's down 62%, by the way. That is the stocks did not crash it much thus far in the first few months to verify a top, 99%. Bitcoin has crashed enough, and it's the leading sector. This is a top now with Bitcoin down 62%. But every major Bitcoin crash has been 87%. And if it follows the dot-coms 20 some years earlier, the last crash will be the worst, and it'll be around 95, 96%. And that's what gets it to $3,000 to $4,000. And if you see that, people will think, oh, Bitcoin was BS. Oh, how did we believe in an invisible coin worth 69,000? That is when you should step in and buy.
I love it, man. Well, so let's pivot here. One of the things that I kind of preach to people right now is the importance of getting to cash, getting to safety, getting your money into places right now, like literally bunker up, you know what I mean? Get ready, and don't worry about losing opportunity over the next 12 to 18 months. Just get prepared to take advantage of the greatest opportunity that you're ever going to see, probably in multiple generations, like 100+ years. Right. And so one of the things that I do is, I speak to life insurance a lot, right? Like, so I utilize whole life insurance policies with my clients and with the people that I consult with, utilizing life insurance as a bunker, because I look at life insurance companies, they've been doing risk management. There's no better risk manager on the face of the earth than life insurance companies. They've been doing it for 170 years, before the Civil War, through the Great Depression, through all this stuff, right? And so, like, I look at that and I go, okay, if they manage that, well, I'd rather them manage my risk through this process, because they've done it time and time and time again. And whether it's inflation that's a concern or deflation, life insurance companies in the 80s and 70s, when inflation was out of control, the dividends went up to 14, 15%. And right now they're lower, but we're in this really crap environment when it comes to returns. So can you talk about, like, what are your thoughts on insurance companies and, utilizing that as like a safe haven kind of a way to keep your money safe and protected?
Well, first of all, life insurance companies were the only sector in the financial services industry in the Great Depression that did well. Only sector. Everybody else got wiped out by the financial asset drop and stock drops and the weak economy. What life insurance companies do to back their policies and to secure them, because you rely on it, they buy high quality treasury bonds and government bonds. What I'm recommending to do. So what they do naturally is their business.
Yep.
Those bonds they're buying are going to appreciate. That's going to give them an extra kick. And again, they're going to go down much less. Now, I'm not saying life insurance companies will go to new highs when stocks go down 60, 80, 90%, because everything will go down. They will hold up by far the best. And it's a great time to get a life insurance policy, because again, people could question a lot of other things you buy. But those policies you buy also are going to be backed by the right investments in a time where anything backed by financial securities otherwise are going to do very poorly. So I think it's the bright star, obviously, financial securities industry. When there's corrections, I would tend to buy that. If I'm time to start buying, that'd be a good sector to buy. I don't really want to be in any stocks right now, but I tell you, I mean, all of this is going to work in their favor long term, be great buy when things get tough. And there's no reason not to buy a life insurance policy, which people have to do. You know, I finally had to do that. What's the age? 58 is when people buy the most life insurance.
Really? That's the
I mean,
number?
I got a number for everything. I'm like,
that's why I love watching your content, because like every time I watch you got like this random statistic that I'm like always blown away by. It's awesome.
Yeah. So I mean, that, you know, that is, they still have positive demographic trends where most other industries don't. So it is really the bright star. But again, I say everything's over. I don't care what it is. The world's been good since 1982, okay? And this boom should have ended in 2007, and they've extended it to new highs into 2021, 22. Yeah. This shouldn't have happened. Don't look a gift horse in the mouth. This is also the longest time between recessions in the history of this country, 13 years going on 14. No intermediate boom, even within a longer generation boom, lasts more than about 10 years, okay? And this one's lasted 13 going on 14. So everything says get safe. And this is a great time. If you want to invest money for your future and guarantee, it's a great time to buy a life insurance policy, and it's a terrible time to buy stocks. And I would see life insurance companies be in the financial service sectors, one of the best to buy when we think stocks are bottoming a year or two from now.
That's awesome. Yeah, I mean, that's great. I hadn't even thought about the stock side of the life insurance company, because we deal with a lot of mutually held life insurance companies that are not publicly traded, right? So as a policyholder, you're participating in the profitability of the company, and they pay you a dividend as part of your policy. So by being a policyholder, you're effectively a shareholder in the company. And so that, what better way to manage your risk, right? Like that's why I love doing what I do so much. And so, and I guess that's why your message has been really, really speaking to me a lot lately, because it's like, it's so lock in step with what's going on in the world. And I think there's never been a more important time than right now than to bunker down and to make sure you're protected. Because I think what people do over the next 6 to 24 months is either going to make the rest of your life really amazing, or it's going to make it really horrible.
Yeah, I call it the crash and the opportunity of a lifetime. Yeah, this comes once in a lifetime. I mean, every 40 years you get it on one level. Every 80 to 90 years you get it on a whole nother level. And we're 90 years roughly from the 29 to 32 crash. Yep. When I look back at history, I have cycles on everything, as you know. Yeah. The 90-year cycle, which is 2 45-year technology innovation cycles. So every other one, and that's true of most cycles too. The baby boom generation cycle in 40 years was stronger than the Bob Hope generation before them. So this is stronger for the financial bubbles and all this sort of stuff. So this 90-year cycle is the most potent. So you have to get out of the way of its crash, but it also means buying at the bottom of that, which I expect around late 2023. We're gonna have to keep monitoring this, but it is gonna be the opportunity like that. You get out at the top of the greatest bubble in history, whether you got it right at the top or not, and you get back in somewhere near the bottom. How could you not outperform your neighbors and other people by 2, 3, 4 times in your net worth? You're saving, losing half of it, and then you're getting back in when people won't touch stocks for years. And then Bitcoin, forget it. Bitcoin goes from 69,000 to 3,000. If I'm even, people won't even touch that, and that would be the number one thing you should buy. So people are going to do all the wrong things, and if you can just see what the real trends are. And understand that bubbles are rare, but understand also, I don't care when anybody tells you it's not a bubble, they're defending something that's obvious. And second, bubbles only do one thing. There hasn't been one single one in all of history, including tulips back in the 1500s or whatever, they burst, and they burst hard and fast when they do. So when they say, well, governments won't let it burst, the governments created this bubble, particularly the one since 2009, when they panicked and said, oh my God, Ben Bernanke, this looks like the Great Depression. And Mario Draghi said, he said, I will print unlimited amounts of money to stop the stock market and economy from going down. That's like insanity to say that. Works. That's how desperate they are and scared they are of this bubble bursting, which should scare you too. So this it's just simple. Get out of the way. Like you say, cash is good. High quality treasury, but long-term treasury are better. That's about it. You know, AAA corporate bonds. I mean, those are the three things: be cash, AAA corporate. I'd have the most money in the longest 30-year treasury bonds, or in TLT or ZROS 2025. That's the place to be. It's not a time to diversify, because everything's going to go down, and diversification will get you almost nothing. In a boom, diversification is great, okay, and rebalancing. In a crash, the secret is just get out of the way and let nature get back. Let nature take back over. And you know what my number one hope for the outcome of this? Central banks are discredited forever. No more do we look for them to try to second guess the economy and decide what's best. You know what Adam Smith caused the free market? He created it, the concept. You know? It's basically the invisible hand. Something that's way smarter than you. It's like the god of economics. You know, it's like your intuition instead of your stupid thinking mind that worries about everything. Okay. This is what they're messing with. They're trying to say, we're smarter than the economy and we're going to decide if we have a recession. And we don't want recessions. That is arrogant. I want these guys to fail so bad, you don't even have a Federal Reserve chairman anymore. It's canceled.
Seriously. No, I love it. And I think we'll get there. I think, you know, it's a time thing, but I think we'll get there. And I think this crash.
Well, after 10 trillion of stimulus in the last 2 years, if we end up down what I think 86% in stocks and in a short-term depression, it's going to look very clearly that they're escalating money printing, easy way out policy didn't work. And I think people underneath, they know just printing money to solve a problem doesn't make sense, but it has seemed to work so far. So people are kind of going, and economists are saying it's fine. That's why I hate economists. You should be more responsible. You think, I mean, you know, it's like, okay, I'm feeling bad. Well, you know how I can guarantee you'll feel good in the next several hours? Shoot some heroin. Guarantee you'll feel good. Is it the right thing to do? No, not by most wisdom. That's what they're doing. Well, I call it, this is the markets on crack. They're just shooting, keeping the market on the crack, keeping it going. Well, the economy and the markets are just getting more stretched and more tired, which means when they go down, they're going to go down harder. And that's where these people finally lose credibility. So if that doesn't happen, I'm going to okay, I'm just going to quit being an economist and I'm going to lose all faith in humankind. If you can't see after this, that this something for nothing, easy way out, central banks, which has been adopted around the world. We're not the only ones. And we're still the best house. We haven't printed anywhere near our GDP as Europe, and Europe hasn't printed near what Japan has. But it's the cowardly, it's the easy way out. That never works out in life. Again, like taking a drink, like shooting some heroin. I feel down. You can get out of down all types of ways, and none of them work out well for your health.
100%, man. No, I love it. And your calls, I mean, I think from what I remember, you've said 80 to 90% in the stock market decline, 50 to 70% in real estate. Is that right?
40 to 50 in real estate, yes.
Okay.
80 to 90 in stocks.
Okay.
And corporate bonds, maybe 30 or something, 30%.
Okay.
Again, but the treasury bonds are different. They're the safe haven. And again, I got to argue the most. And see, people have me with the gold because we're both saying crash. We're both saying money printing doesn't work. So Peter Schiff and I will have the same I have to take out half my slides if I follow him. But our outcome is different. He thinks gold becomes the true money, and gold becomes the safe haven. And I'm like, 2008 and 9 already proved that beyond a shadow of a doubt. It did look like the Great Depression in 2008 and 9. And that's why the Fed panicked so bad. They didn't see a recession. They saw a Great Depression. And that's why they just said unlimited money printing.
But isn't that going to be what makes...
But it shows how bad it really was.
Totally. Isn't that going to be what makes this worse though at this point in time? Because like we were supposed to go through that and then the government didn't really let it play out. So now we've had 14 years of just of making it worse. And so now when it really settles, we're not going to lose just what we kind of printed and stimulated our way to, but it's going to go back to, more 2004, 2002 levels, right?
Yes. Okay. Here's what should have been, okay, by my indicators. And there aren't better indicators, that I know of.
I agree.
That recession should have gone into middle of 2010, like 2000 to 2002 and 1930 to 32. It should have gone much longer, much deeper, and that would have taken out a lot of the excess debt and financial asset prices and gotten us back to a balanced economy. But we would have still had weak demographics. We would have had a rise in there, and we'd have come back now. But we wouldn't have that. What we have now is massively more debt and globally than we had in 2008. So we have much more to have to deal with. And financial asset bubble, when I show people the biggest thing on Wall Street, this isn't really a bubble because, there's a million reasons. I pull up my chart and say, here was the 2000 bubble. Okay, the 1995 to 2000 bubble. Look at this one. This is not a bubble. This bubble makes that one look like a baby bubble. This is the daddy bubble. And a few smart people like Raoul Powell and others around the world and Robert Peck saying, this is the greatest in everything bubble in history. That's the only realistic view of this. If you step back, have nothing at stake. See, I don't work for anybody. I'm in my home office in Puerto Rico on the southeast side in the middle of nowhere, okay? Amen. I don't have any access. I don't have to be bullish. You know how no matter what happens, brokerage firms always come out, well, this is down, but here, they'll always do a positive towards that. No, I'll just call it as it is.
It's like a moral hazard.
I was too bullish when I wasn't bullish enough, by the way, in the late 80s. My Dow at 10,000 by 2000 and went to 12 and a half.
Yep.
People thought I was insane and I under forecasted. Okay. Now people, Harry, the government, we may have some, the government won't let it go down. No, the government created the greatest bubble in history. How are they going to, how is the source the cure?
Yep.
They're just going to, and their tightening is too tepid. This thing is going to fall apart on them. And I cannot wait.
You made a comment the other day, one last thing, because I know we're running up on it, but you made a comment when we were talking over the weekend in Dallas that the velocity of money is like is crashing right now. And so no matter how much money they print, when you look at the charts, as velocity goes down, there's always a lag, right? But then eventually the economy follows it. So can you explain that, just to end this?
This is my number one chart. I got it 25 years ago from Dr. Lacey Hunt. Everybody talks about it. Good, positive money sounds good and negative sounds bad. What money velocity measures is how productively you're investing money. Good money velocity going up means you're investing money, you're getting good returns, and you're able to reinvest that money for more good returns, okay? When it's going down, which has been from 1998 all the way to now, and the last time it did that was from 1917 into 1932. What did that see? The roaring 20s, greatest bubble in history at that time, and the Great Depression, the greatest downturn and crash that time. Money velocity is the truth meter, because it's one thing to invest money. Are you investing it productively? Guess what most corporations are investing their money in?
I have no
Buying
idea.
back their own stupid ass overvalued stock. They're taking the profits of their company, instead of investing in more productive capacity, more companies in growth markets, they're buying their own stock at overvalued levels. And when it crashes, their stockholders are saying, you did what? You gambled our profits on your overvalued stock? Now, they wouldn't think that today, but it'll be
How is that even legal? How is that even legal?
It should be illegal. You shouldn't be able to buy back your stock or past certain levels to make your performance look good. All these companies, their profit earnings per share are going up only because they're shrinking the shares, not because their earnings is growing.
It's almost pure manipulation.
This is misleading. It should be. I would not, as any chairman of the Treasury thing, allow people to do more than minor stock buybacks for credible reasons. You can't buy back your stocks in big levels just to make your performance look good. You're gambling your profits on your own stock, which is not diversified investing. Better to gamble your profits on finding new customers, you idiot.
I love it.
It's unproductive investment. So money velocity is what will tell you, and it measures the whole economy, government, business, and consumers. We have been investing money in speculative things instead of productive profit sharing and profit earning thing since 1998. And this drop, by the way, from top to bottom, is substantially greater than the one from 1917 to 32 that led to the greatest depression and downturn in history. So money velocity would be even more, if I just took that one chart, it would be even more bearish than I'm saying.
So what you're saying is I should sell my house.
Absolutely. And be glad your life insurance policy is not backed by real estate.
Totally. Absolutely. Yeah. No,
It's backed by
love it.
high quality bonds.
I love it. And so guys, if you take nothing from this, I would say heed this warning, like get prepared for the time that's coming, because it's real. And if you haven't already, I would go to harrydent.com and sign up for Harry's free newsletter. It is, I get it. Like every week I go through this and I check it. I always never delete them because, you know, things happen, but I always go back through and I read them, and they're some of the most valuable things, most valuable content that you're going to get out there. This is stuff you can't ignore. Like what's going on around us right now. If you ignore it at your own peril, I guess is the only way I can say it, you know? And so if you haven't followed Harry, you're biggest on Twitter, aren't you? Or like, where do you spend most of your time on social media? Cause you have your,
I'm the best place to watch me, I say, is on YouTube, because you'll get more substantial, you know, video things.
Yep.
But yeah, YouTube and Twitter.
Okay.
But I would look up my videos on YouTube.
Okay.
That's where I go when I see a really good speaker at a conference. I look up their YouTube videos because I want to see them in action, and I want to hear them talk about something for 30 minutes rather than just get a clip.
100%. And I love I do that too. I follow your YouTube channel. So guys, what I'll do in the description below too, I'll put a link, not that he's hard to find, but I'll put a link to his channel so you can subscribe to it, follow it. I would 100% encourage everybody to do that. And Harry, I mean, that's it, man. I gotta say, it's an honor to be able to talk to you. I'm excited about this. And hopefully if you're good with it, I'd love to be able to reach out to you in the future and just stay in touch and keep this going. So appreciate your time. Is there anything else you want to share, or you good?
No, like I say, crash and opportunity of a lifetime. Just like you said, do not take this lightly.
Yeah.
And any time. Okay, I'll say the bad thing about investors, the error we made, the longer we see something go up, the more confidence we have in it. The smart money, the longer something goes up, the more they say, oh, it's cruising for a bruising. That is real wisdom. This is the longest and the most aggressively the stock market and all financial assets, especially real estate, that didn't even bubble that much in the roaring 20s, have gone up. That alone should be a huge caution, whether I'm right about the timing exactly or not. This is a time that's going to pay to keep getting out of risk assets and let them crash and get back into them. It's that simple. You almost can't go wrong on this one. It's just a matter of timing. You might get out a little early or a little late, but getting out of a bubble is the most single profitable thing you can do in history.
But it's that old saying, pigs get fat, hogs get slaughtered. So if you try to be a hog and try to like really time it out perfectly, you could end up getting slaughtered.
Well, yeah, yes. Who's been the best performing fund manager lately? Kathy Woods, who's down 75%, and we haven't even had a big crash yet. She bought the highest flying stocks with no earnings. They get bubbled up the most when things are juicy in the NASDAQ and gotten crushed. And there's people still interviewing her like she's a star fund manager. Look, she's a good stock picker, but she buys the high flying stuff at the top of a bubble and then doesn't change her policy. She's still buying that crap. And it keeps going. The markets are down. NASDAQ, I think 24%. The S&P, I think about 18 to 19% now. She's down 75%, and the fireworks haven't gone off yet on the downside.
It's crazy, man.
And she's doubling down on Coinbase. And it just, you know, she's a great stock picker at the wrong time. But, you know, you need to, that's the problem. The one advantage I have, I'm not a stock picker, but what I would have an advantage to somebody like her is tell us where you are in the cycle. And that tells you what your risks are better than you don't buy the high flying stocks at the top when you're in a bubble. That is when you're going to get crucified. And she's the example. She went from hero to zero in literally a year.
Well, I think you said it earlier. It's the Adam Smith invisible hand thing. Like she's trying to fight that and you don't win. You're not going to win. You may win for a blip, right? Like, but you're not going to win long-term doing that. And so that's it. So no, that's amazing, man. So, well, thanks so much for being here, Harry. I really appreciate it. I really enjoyed this time. And guys, once again, go follow him. I'll put all the links to all of his content, all of his information, so you can go follow him on social. Go to harrydent.com, sign up for his free newsletter. You need to do it. Just trust me. Just go do it. So that's it. Have a blessed, inspirational day, everybody. We'll talk soon. See you guys.